Hello everyone, we have another stock analysis for you today. We are doing Meta. So Meta, we know, is a very popular stock. Before Meta, they were called Facebook as the name of the public company, and they were a part of the FANG stocks. Now with Meta, they are part of the Magnificent Seven stocks. So we have another popular stock to review. We also know that Meta had some reinvestments or reallocations of their capital into the metaverse, which changed a lot of their fundamentals. And during that time, a lot of investors were afraid and ran away, but we see that the stock has rebounded. Investor confidence has come back to the stock. So we're going to look at the revenues. We're going to look at the cash flows, their sources of revenues, to understand where they bring in their money and how they bring it in, and get a good understanding of Meta so you can understand whether this is a good investment for yourself or not. So let's get into it. Starting off looking at the stock price over the past 5 years, Meta is up 190% on the year. So that's a pretty solid gain for 5 years. We also see that, again, as I said, the stock dropped dramatically in 2022 going into 2023. This is when they changed their name to Meta and started changing their focus to building out the metaverse. And it's a new venture. It was a very bold move, and a lot of investors still don't understand what the metaverse is going to be in the future. So a lot of people ran away from this stock. A lot of people said it was dead. I don't know if you remember and keen on what was going on social media, but a lot of people were criticizing their moves, and we see that they rebounded over the past year and some change. They're up to $528 as of now. So that's a pretty significant rebound. So let's look at the sources of revenue. A lot of people say things about a business without understanding what the business actually is and how they make their money. So I like to look at the financials. That is a source of the information that I look at to understand what the business actually is. So we see that there's two segments for Meta. That's the family of apps, which is Facebook, Instagram, Messenger, WhatsApp, and Threads, and Reality Labs, which is virtual reality and metaverse. So those two segments are their sources of revenue, and we see that 99% of their revenue is coming from the family of apps. That means that 99% of their revenue is ad revenue from those apps. So when you think about Facebook or you think about Meta, you have to think about an ad revenue company. They are a social media ad revenue business. That's how they make their money. So keep that in mind, as it is a software business, but they're a software business that brings in the money through advertising. Now they do have some of the subscriptions for Facebook for verification, but the bulk of their revenue is advertising. So that's their two sources of revenue. So $133 billion coming from the family of apps, 1.8 billion coming from Reality Labs. Again, this is an ad company. So going to revenues, looking at the revenue trends over the past 5 years, 10 years. So you see in 2014, starting at $12.4 billion in revenue, all the way up to 149 trending for the last 12 months, 134.9 last year. So excellent growth. We see that each year leading up to 2022, pretty solid, above 20% for every year. So this is an amazing period of growth here. We see that we have a negative 1% here. This was their down year where a lot of people began to doubt this business, but they rebounded pretty solid rebound to 15 and 11%. Not as great as before, but this is understandable as Facebook is so dominant in their space. So basically anybody who wants Facebook has it, or anybody who has the ability and also wants it has it. So sooner or later, when you're dominant and you're at the top of the mountain, there's no way to go but to come down. So you see that some of their revenues did come down, but there's still a lot of growth potential for this company, I believe. So with the company this successful and dominant, a few bad years can be understandable, or in this case, one. So not necessarily because it's a bad year. They still had significant revenue and great margins, but the growth wasn't there. So people were kind of weary. So understandable. Looking at gross margins, we see they started off at 82.7%, still at 81. Their worst year was 78%, that same 2022 year. So pretty solid margins that they are holding. So you don't see much deterioration or improvement there. But again, tech company, solid margins averaging about 80% over the past 5 years. And then profit margins, 23% going up to 34%. So they're staying pretty efficient and they are growing in their profitability. These are great trends for this business. So going to the balance sheet, we're looking at debt to free cash flow. How much debt are you carrying on your balance sheet compared to the free cash flow that you have that's able to pay off that debt? We want a company to be within a range of 3 to 5 years. 3 or better is amazing. 5 is still reasonable. We want under 5. So we see that Meta, they averaged 18.5 billion on the books for the past 5 years. We see that trend is increasing to 35.6 right now, or at least at the end of 2023. Compared that to the free cash flow, the worst that they've ever been in the past 10 years is being able to pay off that debt in 1.3 years. That's great. Like I said, we want 3 or less. They always stay within that great range. So averaging at 0.6, a little bit over half of a year to pay off their debt. Great leverage. This is a great position for them to be in. So let's look at the free cash flow. How much cash are they generating from their business? We know that the free cash flow is the cash generated from operations minus capital expenditures. Once they invest the required reinvestment back into the business to keep the doors open, what cash is left over, and that's what their free cash flow is. So looking at 2014, we have 3.6, went all the way up to 49.6 billion in the past 12 months. 43.8 for 23. So pretty solid. Again, 2 years of negative growth. We have 12% here and we have 51%. Again, this coincides with the reinvestment of the cash flow into Meta. Now you have to understand something about their cash flow, because this is one of the biggest things that made investors run away. Meta was able to generate cash flow, but they made the choice to put excess cash flow into development of the metaverse. So there's a difference between a company who is generating the cash flow and choosing to put it elsewhere or to put more significant investment somewhere versus a company that can't generate the cash flow. And that's the reason for the decline in their free cash flow. So you have to make that distinction when you see a trend that's negative for a business. Why is a trend there? If revenues are pretty consistent or growing, but free cash flow is coming down, what is that business doing differently to impact that cash flow? Now, again, if the business is generating it and just choosing to put it somewhere else, we'd much rather have that than a business that's not able to generate the cash flow. Meta is a business that was able to generate it. However, they put it to the metaverse. They made a conscious choice to do so. Now, one thing you have to understand, if a business is doing that, at any time they can change their strategy and pretty much replenish their cash flow balances or trend based on their spending or management's decisions. So Meta was in that position where at any time they could choose to not spend that money into the metaverse, which they've dialed back on that as of recently. So we see that that negative 51% was followed up by 130 and 13% right now. So again, with the free cash flow similar to the revenues, we have some significant growth. Then we have some kind of tailing off of the growth in the more recent periods. So we want to keep an eye on that as we go through this analysis. But overall, free cash flow is in a great position. Now, looking at the dividends, Facebook began paying a dividend this year in 2024. So right now, they're at 50 cents, 0.19% dividend yield. So not very strong, but makes sense for a company that's just started their dividend and a company that's this expensive right now. So we see that the payout ratio, how much of their free cash flow is being paid out in a dividend, 11.3%. This is not very high, it's very low, which we like. That means they have more room to grow that dividend. But Facebook or Meta is a company that has a lot of opportunities for reinvestment. So as an investor, if I'm holding Meta, I don't want this to increase a whole lot. That's a company that can reinvest that free cash flow into the business at a high return. So I don't want a lot of that coming to me as an investor through the form of a dividend. Share buybacks, great. Reinvestment into the company, great. I don't want this to grow, I would say, more than 5% per year. I want that to stay growing. Maybe it's right at the inflation rate or just above inflation. Even if it's not, again, Meta's a business that can have opportunity as a tech company to reinvent and spawn into new business segments and develop at a high rates of return. So I don't want this to grow. So we'll see how that plays out. But right now, I believe this is a solid dividend policy for where they are and where they're going. When the company begins to pay a dividend, what they're saying is we have so much confidence in our ability to create future cash flows that we now see some of this cash flows as being extra. So now we're going to start putting that back to the shareholder in the form of a dividend. So that is, again, solid for them. I like where they're doing with the dividend, and I will keep an eye on it. As an investor, again, I don't want that to grow a whole lot over the next few years, as they are, in my opinion, a company that has much more opportunity for reinvestment. So looking at the shares outstanding, we want a company to decrease the number of shares over time. When they decrease the shares by buying them back from the market and taking them off the table, the existing shares now have more of the business. So we always want to see a downtrend for the most part when we're looking at shares outstanding, and we see that's exactly what Facebook is doing. Over 2.9, now they are at 2.6 billion shares existing at the end of 2023. Consistent downtrend, so we like that. Amazing, looks great. Now looking at the value creation, I like to look at the return on capital and compare that to the weighted average cost of capital. Basically, I want to know, does the company generate value by just having its doors open and continuing operations? How do I know that? I want to look at how much return they're getting on their capital. Their capital is debt and equity. You're getting debt, you're getting equity from shareholders and investments to create a return. What is that return based on the debt and equity that you have? And also, how much of that debt and equity cost? What is the opportunity cost versus the interest expense on the debt? So once I see that return, I'm going to compare that to the weighted average cost of capital. What is your cost of capital or equity? And then what is your cost of debt? Looking at the weighted average, if your return on capital is higher than your cost of capital, you are creating or generating value every day that the business is open. So this year we see that comparing those two numbers, Meta is at 15.81%. That's pretty solid. When looking at other software companies, we're at 13.28%. So they are beating their competitors on average by 2.53%. This is great. We see that they are generating value continuously and also at a higher rate than their competitors. So we like that. Now, thinking about the valuation of the company. Now, looking at revenues, we'll peek back at revenues again. Now, remember, they were growing at very high rates, but after this dip in 22, they bounced back with the 15.7 and right now 11% return. So I would not expect these high rates of increase each year moving forward for a company this dominant and this mature. Again, once you're at the top of the mountain, where is there to go? So looking at, okay, they have 11% here. Analyst estimates are estimating 12%. I don't know if they can keep that up. So just for a little bit of safety, just looking at the stock price, I am going to estimate a 10% growth for the year, for the next 5 years. So once I do that, a 10% growth, I'm looking at a $404 intrinsic value for the stock. So I'm saying that this stock is overvalued by $124. Just my assumptions. Now, I want you to see how much things can change with just a little bit of increase in the assumptions. If I believe the analysts that are saying that's going to grow at 12.19%, let's say I just put 12% there. If they're going to grow at 12%, the stock would be worth $616 and is undervalued by $87. So just a small change in your assumptions can throw that price off by a lot. This is why you always want to be conservative and you always want to have a margin of safety. That way, if you're wrong even a little bit, you can still have significant gains with your investment style. Now, I'm speaking from the perspective of a value investor. So again, I believe based on my assumptions that the stock is not worth more than $404. I can even put more margin of safety and say they're going to grow at 9%. If I do 9%, they're at 348. So it all depends on what you believe about the industry and their growth opportunities and their ability to maintain consistent above average growth. So one thing I wanted to point out, when it comes to investing, you always have to have a long-term view. Remember, as I mentioned before, many people ran away from the stock during this time period due to fear of some of the strategy changes, and understandably so. You know, this is not just something that was bad news on the market. Yes, there were a lot of people being negative, saying that the company was dead. However, in this case, I totally understand it because the fundamentals of the company were kind of shifting in how they were allocating their capital. But one thing I want you to always keep in mind, number one, we saw that when it came to their revenue growth, they only had 1 year of negative growth, and it was only a negative 1%. It wasn't a drastic decrease in company performance. And notice how the reaction of the market was during that time. Now, to be fair, I understand that when the market is falling down, this is where you're at. The market goes from here over 350, it's like about 375, down below 200 in a few months. That is a scary thing to experience if you haven't already. How can you have conviction of a business enough to hold when they go down by that much in that short amount of time? You don't know what's going to happen next after this. You don't understand. This is April of 22. You don't know what's going to happen. You don't know if it's going to continue down more. You have no idea. Now, some investors, I would say some people lucked out and some people had a decent strategy where they didn't lose faith in the company and they were able to enter in at low areas. But as an investor, this is a part of investing, having the conviction to hold. When you have the convictions in the great businesses, that conviction pays off in the long run. I promise you it will. As we see in this case, the stock went down, but again, like we talked about before, you had this excellent rebound, pretty sharp rebound as well. So when you have all of these dips, always think long term. What is the likelihood that this company is going to fail, or what's the likelihood that the stock price will trend up in the long run? And that's what you have to think about when you have these dips. So as we see, Facebook has some change in strategy slightly and a decrease in revenues by a little bit. And then here, boom, there was a great buying opportunity for a lot of investors. So always have the conviction in the quality businesses. As we see, Meta is definitely a quality business. Again, if you're lump sum investing, this is definitely one I would say probably put on your watch list and watch until it gets to a price that you like. If you are dollar cost averaging, this is one that you go ahead and be consistent and continue to invest in this type of business. So as we see, revenues, free cash flow, balance sheet, dividend, shares, value creation, all positive, all great. The only thing that did not look great was it properly valued? It looked to be a little bit overvalued considering our conservative growth estimates about 9 or 10%. If we were to go to 12%, it would be a great buying opportunity. But again, we want to be safe. We don't want to assume exactly what the analysts are saying because many of them are going to be more optimistic as well than they should be. So always be conservative. So I hope you enjoyed this analysis of Meta. Hope you learned something. If you enjoyed this video, please consider liking and subscribing. In the comments, let me know what videos or what businesses you would like for me to review in the future. And I hope to see you in the next video.